Hi, greetings. It's me, Dr. Paul Gerhardt, and this is the fourth video in our mergers and acquisitions series. This one's all about takeover tactics, activist, hedge funds, and sustainable value. So let's get right into the video. Today we're going to focus on comparing major takeover tactics and explain why each may be effective. We're also going to learn how to evaluate how activist hedge funds can affect post-merger employment and operating performance, as well as learning how to develop a critical strategy for persuading institutional shareholder value during a proxy contest. So let's get right into the central question. A takeover is not simply an offer to purchase a company. It's a contest over control, strategy, credibility, and value. A bidder may want ownership of the company. An activist investor may want only a few board seats. The target board may believe that remaining independent will produce great value. Institutional shareholders must decide which position offers the strongest risk-adjusted and most executable outcome. The central question is, therefore, not merely who is offering the highest price. The better question is, which proposal provides the most credible path to sustainable value after considering price, execution, risk, organizational capability, and stakeholder consequences. So let's talk about how takeover tactics work. Most bidders prefer a negotiated acquisition because cooperation allows due diligence, coordinated planning, financing discussions, and board support. When negotiations fail, the bidder may escalate. A bear hug is a serious acquisition proposal, often offered at a substantial premium that places pressure on the target board to negotiate. The bidder is essentially saying, this offer is attractive enough that the board will need to explain why it refuses to consider it. A bear hug creates pressure, but it does not give the bidder control. A toehold is when a bidder may purchase a small ownership position before announcing an offer. This toehold may reduce average acquisition costs, provide voting influence, demonstrate commitment, and produce gain if another buyer eventually succeeds. However, accumulating shares may trigger disclosure obligations, defensive measures, or regulatory scrutiny. A tender offer is when it asks shareholders to sell their shares directly to the bidder, usually at a premium. For example, assume a target stock price is at $40 and the bidder offers $52. The stated premium is 30%. That does not mean shareholders will automatically receive $52. They must consider whether financing is committed, whether regulators will approve the transaction, whether enough shareholders will tender, whether the target's defenses can be overcome, and how long the transaction may take, as well as what happens if the transaction fails. The highest stated offer is not always the best adjusted offer. All right. A proxy contest seeks shareholder votes rather than directly purchasing shares. The bidder or activist may nominate directors who support negotiation, restructuring, or a different strategy. A full slate attempts to replace enough directors to control that board. A short slate seeks only selected board seats. Under the universal proxy system, shareholders can choose individual candidates from both the company and dissident states. This makes the qualifications, independence, judgment, and experience of each nominee especially important. Now let's talk about comparing the tactics. A bear hug is useful when a bidder wants to create pressure without immediately beginning a full hostile campaign. A tender offer is useful when the bidder has a compelling premium, credible financing, and a realistic path around the target's defenses. A proxy contest is useful when shareholders are dissatisfied with the board or when changing directors may be necessary to advance a transaction. A toehold may provide influence and demonstrate commitment, but it rarely produces control itself. The most effective campaign may combine several tactics. A bidder might begin privately, issue a bear hug, launch a tender offer, and nominate directors through a proxy contest. So let's talk about activist hedge funds. An activist hedge fund acquires a meaningful minority position and attempts to influence the company. The company may demand board representation, leadership changes, a sale to the company, asset divestitures, share repurchases, cost reductions, operational improvements, and changes in capital allocation. Activists do not need majority ownership. They create influence by developing research, communicating a persuasive thesis, developing shareholder coalitions, and using voting rights. A typical activist campaign allows this sequence. 1. Identifying a performance or governance problem. 2. Build an ownership position. 3. Develop a case for change. 4. Approach management privately. 5. Decide whether to negotiate or begin a public campaign. 6. Seek shareholder support. 7. Obtain strategic or governance change. And finally, 8. Monitor whether the plan is actually implemented. Winning a board seat is not the same as creating value. The proposed changes must still be executed successfully. Now let's discuss constructive and confrontational activism. Constructive activism begins with private engagement and negotiation. Its advantages include less disruption, lower costs, and greater opportunity for cooperation. Confrontational activism may involve public letters, media campaigns, director nominations, litigation, or direct appeal to shareholders. This approach can create urgency, but it can also produce distraction, polarization, employee uncertainty, and reputational damage. The loudest campaign is not necessarily the most successful campaign. Okay. So let's discuss activism, mergers, and employment. Activist investors may pressure an acquiring company to reduce costs after a merger. Some reductions may be reasonable because the combined companies may have duplicate corporate departments, overlapping facilities, multiple management layers, redundant technologies, or similar products or services. However, eliminating positions does not automatically improve performance. Research discussed in this module indicates that activist involvement in acquiring firms may be associated with greater post-merger employment reductions, but those reductions do not necessarily result in stronger operating performance. This is one of the most important lessons in the module. Headcount reduction is an action. It is not proof of success. A merger can meet its expense reduction target and still fail because of many reasons, including customers leaving, important employees resigned, knowledge is lost, information systems remain incompatible, innovation declines, integration costs exceed projected savings, debt payments consume the savings, cultural conflict disrupts execution. Managers must distinguish productive restructuring from destructive downsizing. Reproductive restructuring, productive restructuring. Begins with strategy, designs the future operating model, identifies genuine duplicating, protects critical skills and knowledge, sequences change carefully, considers customers and employees, and finally measures financial and operational results. So let's talk about destructive downsizing. Destructive downsizing begins with a percentage cutting target. It eliminates positions before work is understood, sacrifices critical capabilities, measures only short-term expense reductions, creates uncertainty and repeated layoffs, and ignores customer quality and innovation risks. The correct sequence is strategy, operating model, processes, systems, roles, and then staffing. All right, so here's a little bit of information about winning institutional shareholder support. Institutional shareholders include mutual funds, pension funds, insurance companies, endowments, and major asset managers. They do not automatically support management or activists. They generally evaluate 5 questions. Has the company underperformed? Why has it underperformed? Has the board responded credibly? Is the proposed alternative realistic and superior? And are the proposed directors qualified to execute the plan? A strong proxy campaign should present the problem, what has happened, and why does it matter? Accountability. How did management and the board respond? The alternative. What specifically should change? Capability. Why are the proposed directors or leaders qualified? Value. What measurable outcomes should shareholders expect? Risk. What could go wrong, and how will those risks be managed? The vote. Which proposal or candidate should shareholders support? Institutional investors are more likely to support the campaign when the argument is evidence-based, consistent, realistic, and respectful. They're less likely to support the campaign based on personal attacks, exaggerated projections, vague promises, or unqualified nominees. A company defending its board should not simply deny every criticism. A credible board acknowledges legitimate problems, explains corrective actions, identifies accountable leaders, and provides measurable milestones. Here's what you need to know about the managerial decision framework. When evaluating a takeover or activist campaign, ask, what is the actual problem? Is the performance gap supported by evidence? What tactic is being used and why? Does the proposal have credible financing and leadership? Can the proposal be implemented realistically? What could be damaged during the implementation? How will success be measured? Does the plan create sustainable value or primarily short-term financial gains? The final lesson, takeover tactics and hedge fund activism are mechanisms for influencing ownership, governance, and strategy. Their effectiveness depends on much more than pressure or publicity. Success requires credible financing, qualified leadership, shareholder support, realistic implementation, and disciplined communication. Likewise, layoffs and cost reduction should never be treated as automatic evidence of improvement. The strongest bidder or activist is not the one that creates the most pressure. It's the one that presents the most credible and executable plan for sustainable value. The strongest corporate defense is not denial. It's accountable leadership, qualified directors, measurable improvement, and transparent strategy. So consider this. An activist hedge fund wants 3 board seats and demands rapid post-merger workforce reductions. Management agrees that costs are too high, but argues that immediate layoffs would damage customer service and systems integration. Ask yourself, what evidence should shareholders require from activists? What evidence should management provide? Which positions represent genuine duplication? What capabilities must be protected? What director candidates are best qualified? How should success be measured 2 or 3 years later? Your answer should balance financial discipline with execution risk, organizational capability, and sustainable value. This has been video number 4 on takeover tactics, activist hedge funds, and sustainable value. I hope you've learned something from this video, and more than anything else, I hope that you have a great day, because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.